Now, without further ado, it is my pleasure to introduce today's first speaker, Sanjay Panaya, SVP with Ipsos's Innovation Team. Sanjay, you have the floor.
Thanks, Ellen, and thanks everybody for joining. I hope you're all staying safe and healthy. I do appreciate you joining my colleague Chris Palmer and me today, and for making time to participate in this webinar on the future of fintech and what to expect in 2020. In today's session on the future of fintech, we'll start with a mercifully brief introduction on who we are, setting the stage, then get right into the heart of it, fintech trends we've been tracking, themes we've observed, and specifically our take on what to expect in 2020. A couple of points here I wanted to make at the top. First, we're focused primarily on the US fintech space. I know we have a few participants in international markets today, perhaps from markets where fintech is more advanced than the US. I do hope you will still find something useful from our US-centric observations and see how that might be valuable and apply in your own market. Secondly, clearly what happens to the economy more broadly and the fintech space in particular in 2020 is heavily dependent on the coronavirus pandemic, any efforts to contain it, how long that takes, all of that will impact what happens. While we do not claim to have a definitive answer on that broader question, we're going to focus today on the fintech themes that we believe still hold in this space and we can still look forward to in 2020. So finally today we'll wrap up with a quick recap and what else we'll be watching for in the fintech space in the future. So who are we? For those of you who don't know us, Ipsos is a global leader in market research as well as public opinion polling. We've been in business for over 40 years and have a presence in 90 markets around the world. We are a passionately curious team of researchers seeking to provide a true understanding of society, markets, and people. Ipsos does do work across industry verticals and has strong established practices in several sectors, with financial services and fintech being a particular specialty. Chris and I are in the innovation and product development specialism within Ipsos. We focus on consumer and B2B end-user testing of products and services, essentially proof of concept work in technology, financial services, and fintech spaces. We are involved from early stage idea development, concept and product development and design, product optimization, validation, go-to-market launch strategies, and beyond. We also test ideas on our own for R&D purposes and to keep up with the space, and several of the case studies that we're going to talk about today do influence the themes that we're going to address. We'll be sharing some more consumer case studies with you during the presentation. So before we get into the themes and trends for 2020, let's set the stage. 2019 was a really strong year for fintech in the US. Total fintech funding was about $60 billion. It's a number coming out of a KPMG report, and that's coming on the heels of a strong 2018 as well. We did see less funding for fintech startups than in recent years, according to CB Insights data. But we did see funding grow for later stage fintechs. And there were about 13 new fintech unicorns with valuations of more than $1 billion created in 2019, although I believe that is a global number. On the consumer side, we continue to see consumer adoption ticking steadily upwards. And this is happening across the board in fintech, across mobile payments, mobile banking, investments, as well as lending and financing. And finally, it seemed like 2019 was the year that fintech really went mainstream in the US. For those working in the space and following the space, it might have seemed like a long time coming. but it seemed like finally fintech wasn't just a phenomenon in Asia or Europe, and it truly came to a head in the US as well. From the sheer activity levels, the sort of mainstream share of voice for fintech, the levels of consumer adoption, and the amount of funding, 2019 was another banner year for fintech here in the US. So with that backdrop, where are we going from here and what can we expect in 2020? So getting into it, here are the 6 themes or trends we'll talk about today. Number 1, changing what a bank really is and the explosion of banking as a service. Number 2, expecting the unexpected, particularly when it comes to competition. Number 3, broadening the definition of trust and what that really means. 4, emphasizing tech, but not for its own sake. 5, focusing on the underserved market segments and use cases. And finally 6, partnering with merchants. With that, I'll turn it over to Chris to talk us through our first few themes today.
Thanks, Sanjay. Hey everyone, I'll be taking you through the first 3 themes. And first up, we're going to talk through a trend we've been tracking in consumer deposits, which is really raising the question, what is a bank anymore? So before we get into what exactly banking as a service is and what it enables, I think it's important to highlight kind of how this came about or why this came about. And the first factor to consider is the consolidation of deposits over time. So around 2000 and pre-2000, we saw regional banks play a huge role in the financial lives of everyday Americans, essentially. And since then, we've seen the largest banks, JP Morgan Chase, Bank of America, Wells Fargo, Citi, grow their share. And that's a factor of both consumers switching their deposits, but also these banks purchasing some of those community banks. So a consolidation of deposits around a relatively small amount of banks. And the second factor is kind of this opportunity where there haven't been many new banks entering the market since the financial crisis. So before 2008, we saw hundreds of bank charters issued every year. And then from 2010 to 2018, we saw 25 in total across those 8 years issued. So we see a lot of deposits with a relatively few number of banks and a higher barrier to entry for new banks. So now we can get into what banking as a service actually is. And it's essentially offering the back office operation of a bank to a brand at a fee. And that allows a whole host of benefits for the brands that purchase the service. But I think the key one to keep in mind is that it allows these brands to sit atop regulation that they would really need a bank charter to kind of circumvent it otherwise. So that's really the key benefit. In addition, they might get access to ATM networks and a bunch of other things. But the regulation, especially with the tightening around how many people can get a bank charter, is especially important to keep in mind. So now we'll look at who's providing banking as a service and who are they partnering with. And what we generally see, I've listed 3 of the kind of the new entrants, the challenger banks. Here, Uber recently introduced a banking feature and their partners. And what we see is traditionally it's regional banks. The banks that have been getting squeezed by the largest banks in America are taking on this as a way to kind of increase share or maintain share, even though they don't necessarily have the digital capabilities or the branding of some of these new brands. We also see some prepaid card players like Green Dot getting involved in the space, and they have a bank charter as well. I think it's also important to note with kind of today's environment how this could change going forward. So regional banks are likely to struggle coming out of the COVID situation because of their focus on face-to-face interactions to kind of drive business. But also, without them having, most of them without having an investment arm, they rely heavily on their lending revenue. And in a low interest rate environment and an environment where some of those loans might default, they're likely to lose out on a larger share of the business than a larger player would. So we may see more regional banks getting involved in banking as a service as a way to maintain share, essentially. One of these challenger banks that uses banking as a service that we've been tracking is Chime. Chime is one of the largest. So it has a $5.8 billion valuation and 5 million users. And it's kind of unique the way that they do business. They focus on a very specific segment of middle incomes, $35,000 a year to $70,000 a year, and they're very explicit about this. Chris Britt, their CEO, has been quoted saying, if you make $150,000 a year, you may not love your bank, but you probably don't hate it, and our products aren't devised essentially for those customers. So what is their feature set? Essentially, they won't charge you fees for anything. They'll get you your paycheck early, and recently they've actually introduced a new feature where they'll let you overdraft your account up to $100 if you have a direct deposit relationship with them. So it's all about enabling this lower income group to kind of meet their goals and be aligned on their side by not charging them fees. Now they make their money through their debit card. When a customer swipes their debit card, they make money on the interchange fee from Visa, actually. So their revenue stream is all kind of aligned with the consumer. So Sanjay talked about some of the case studies that we walked through. So we've tested Chime, and I'll walk you through the results and how we think about testing innovations. So the first thing that we look at is the key measures. So we ask a whole host of questions, and then we compare those scores to our database of financial services concepts that we've tested. Anything that's in blue means that it's above average, and the darker blue means that it's in the top 20% of things that we've tested. So we see Chime is seen as very unique and attracts a small but very committed group with kind of average broad appeal. We summarize that pattern in something we call an archetype, or the personality profile of the innovation. And this is niche targeted, meaning it attracts that small group that kind of has limited broad appeal. And if we think back to the quote on the last slide, that's almost exactly what Chris Britt was saying, right? So it tested kind of, I think Chime would be very happy with these results. The next thing that we look at, especially for digital innovations, is emotional resonance. This can be an indication of, does this have staying power? Is this innovation going to be sticky? And we look at this in kind of three avenues. The first is, does it give consumers a sense of control? Does it enhance their lives in some way? And is it doing something for them essentially without them having to lift a finger? And what we see with Chime is that it's pretty strong on all of those, but it could be possibly doing a little bit more without consumers having to do anything. So is there more automation that they could integrate into the platform? And the last thing that we look at is, how is Chime messaging? And we have people go through and select things that are especially relevant or unique or hard to believe. And summarizing kind of those findings, what we see is the no-fee positioning is very relevant to consumers. It's also seen as unique, as is the getting paid 2 days early, the early paycheck. But for some, it's a little bit too good to be true. Some of these benefits are hard to believe, likely because they're not typically offered by other providers, at least incumbent providers. So as we wrap up this theme, I want to bring back in the opportunity slide, because things do change quickly in this space, and what we've seen is that there are more and more fintechs kind of trying to get that bank charter, trying to be a full stack provider. So we saw, 2010 to 2018, 25 new reporters or new bank charters. In 2019 alone, there was 13 new bank charters issued, and even more recently in 2020, you may have seen Square, which offers point-of-sale terminals to merchants and also sponsors the Cash App, got approved for a partial banking license. So we may see more and more fintechs reaching out and getting approved for bank charters. That being said, banking as a service is not going anywhere. Plenty of these challenger banks are quite happy with kind of their current setup. Chris Britt, the CEO of Chime, has basically come out and said, we're really good at branding, we're really good at designing feature set. We don't have too much experience in back office banking, so we're happy to kind of outsource that and pay a fee and focus on what we're good on. So both business models will continue, and banking as a service isn't going anywhere. The next trend I'm going to talk through is expecting the unexpected. This kind of ties nicely with banking as a service, as it's kind of who can reap the benefits of banking as a service. And it's really anyone with a large user base. So last year we saw T-Mobile come out with a banking product, and it's really anybody with that reach could introduce a banking product. So heard rumors about Chewy in the pet supply delivery space. Amazon's always lurking, other big tech. Even, to get as crazy as it could be, could a celebrity who has a large following introduce a banking product? Case in point, and we alluded to this earlier, Uber announced that they would be coming out with a checking account for their drivers. What's really interesting about an Uber checking account is for those drivers, it's likely that money never touches an incumbent's balance sheet, essentially. So they get paid by Uber, they use the card to pay out, and it never touches a large bank, unlike many of the other fintechs that kind of drive off of a traditional checking account. And big techs quickly behind them. We saw Google announce plans to get involved in the consumer checking and savings game, and they're looking to partner with Citibank on that. Likely to see other movements coming out of the space relatively quickly, relatively soon. The other group to look at is investment banks, which are also moving into the space. Marcus from Goldman Sachs has been out for a little bit now, so that was a savings account, and they've also announced plans to get into the checking account game, and they've already introduced a credit card with Apple. Speaking of Apple, Apple was a bit early on the kind of non-financial service players getting into financial services. So back in 2014, they announced Apple Pay, and I think it kind of struggled for a little bit. Consumers didn't really see the need to switch or to start using Apple Pay at point of sale, but they've kind of pushed through, and they've continued this development, and now they have introduced the Apple credit card, and I think even Apple Pay has hit kind of an inflection point now where people are more comfortable with it. That's probably also even more true in today's environment. Contactless payments are kind of taking off, given concerns of the virus. So we've tested the Apple credit card, and we see it's very strong. People like it. They see strong value. It's unique. It fulfills a need for them, and they intend to use it. And the things that are motivating, we see normal things that we see when we test a lot of different credit cards, such as cash back and the no fee structure. But some of the differentiators are this idea that it's fully integrated into the Apple environment, and it encourages you to pay less interest, and it's kind of simple and transparent. So those are some of the differentiators for this card. So kind of continuing into expect the unexpected, maybe we should start expecting Apple to essentially announce a checking account in the near future, especially given their relationship with Goldman Sachs, which has already introduced or laid plans to introduce a Marcus checking account. It doesn't seem like an Apple checking account is too far away. The last theme I'll walk you through before handing it off to Sanjay is the broadening definition of trust and how that could kind of become a core positioner or a real value prop going forward. So first, kind of walk through, we've talked about a couple of different sectors and how trust is kind of eroded in each of those sectors over time. First, with the large incumbent banks, even though we're kind of removed from the 2008 financial crisis, and we talked about the large incumbents have kind of swelled in deposits, there really is kind of some lack of trust or lack of value alignment with those brands. And even though they do kind of have historic numbers in deposits, I think it represents a hole that once a provider comes who's kind of putting others' values ahead and using trust as their cornerstone, you could see a mass kind of exodus of deposits away from these large incumbents due to lack of trust from the 2008 financial crisis. The next group we've talked about is kind of big tech, brought in the Cambridge Analytica and Facebook scandal here, but I think that, everybody's a little wary of the tracking capabilities of big tech companies and how much data they already have, so there may be some nerves around giving them more data, especially financial data. And the last group we've talked about is these new players, and even they aren't, without their stumbles. Robinhood, just 2 weeks ago, had users frozen out of their platform during some of the most volatile days since the 80s. And Chime, one of the stronger fintechs in the U.S., had outages where their lower income individuals were frozen out of their accounts and couldn't access their money for days. Groups that, these consumers probably don't have a second bank account or anything like that. So these stumbles, hit every sector. And one fintech we think is poised to win here or is already winning is Credit Karma. So Credit Karma recently sold for $7.1 billion to Intuit and has over 100 million members. If you're not familiar with Credit Karma, yes, they are the free credit score people, but they also use kind of all that data that they collect on you to recommend products that can help enrich your financial life. So say, they could recommend a loan product that would help you consolidate your debt at a lower rate, things like that. And you would think to recommend and link you with lenders, they would have to share a lot of data with those lenders. And they actually don't share any data. So some lenders will hand over their underwriting algorithm to Credit Karma so that they can be matched with lendees. But if a lender does not want to send over their algorithm, Credit Karma actually has a team of data scientists that will reverse engineer that algorithm based on past loans that have been handed out so that they can still match you with a provider without sharing your data. And that data security, that overinvestment almost in data security is so strong, especially given today's concerns around data privacy. So we see this as a kind of a trend that could grow going forward, where data privacy and trust and aligning your values with the consumer is really a core positioning and a key motivator to sign up. Now I'll hand it back over to Sanjay.
Excellent. Thanks, Chris. So another theme we've noticed across successful fintechs and players in the space is that the tech is critical, but it should not be for its own sake. So tech should serve a consumer or user benefit, or else it's useless. And technology and AI, especially in customer servicing, right now is particularly critical in today's environment. So yes, it's important, but remember to emphasize the consumer benefit, which all may sound a little bit like marketing 101, but it's easy to get so focused on the cool tech that you don't quite emphasize how it benefits the end user or solves a consumer need. Let's look at Lemonade, which of course is a very successful insurtech and one of the first insurtech unicorns. They're relatively tiny right now in terms of number of customers or revenue compared to traditional insurers and incumbents. Although Lemonade is growing rapidly, and most importantly, notice the profile of their customer base. 75% are under the age of 35, and critically, 90% are first-time insurance buyers. So they're serving an underserved market and not necessarily competing for the same customers who have had lifelong relationships with incumbents. What Lemonade is essentially doing is turning the insurance business model on its head, or claiming to. They are a mobile-first AI and behavioral science-focused discount homeowners and renters insurance carrier that also does social good. So Lemonade has a renowned behavioral scientist on staff, Dan Ariely, the author of Predictably Irrational, is their chief behavioral officer. This is sometimes referred to as peer-to-peer insurance. The way the Lemonade business model works is that they are simple and transparent. Of all the revenue that they take in as premiums, Lemonade takes a small flat fee. To run everything, they process and pay claims super fast, most within 5 seconds, and then they give back what's left to causes of your choice or that you care about. Unlike the traditional insurance business model where there's an incentive for the carrier to deny your claim, potentially, because what doesn't go to paying claims goes to company profits, Lemonade has no such incentive with the flat fee that they take. And where the behavioral science comes in is that because what's left over goes to causes, customers are less likely to embellish claims or have dishonest and fraudulent claims, since they know they're cheating a charitable organization they care about rather than Lemonade itself. And Lemonade has a lot of AI baked in, specifically to help customers sign up within 90 seconds is the claim, address customer issues with their chatbot, and importantly to process claims super fast. And they talk up their bots a lot. When we tested Lemonade, we do see lots of good things, strong scores overall, an above average market success score, which is indicative of a strong probability of success, a very desirable want innovation archetype, which is something that's based on the pattern of scores that you see there, the key performance indicators there, but is essentially indicative of a potential trendsetter. The interesting part of the findings, though, and what I want to highlight today, is the messaging elements from a concept highlighter exercise on the right. Notice that the phrases that are considered least relevant reference Maya, the charming AI bot, or Jim, the claims bot. Nobody cares that Lemonade has these AI and these bots, and interestingly, people don't consider these especially unique either. But notice also that one of the most relevant elements is that Lemonade pays claims super fast. That consumer benefit is super relevant and interesting, but the fact that Lemonade has AI and bots that power the claims processing in order to get that benefit, not so much. So again, focusing on the tech and the AI, but not for its own sake. Another theme we'll talk about today is that successful fintechs, like many truly disruptive innovations, tend to focus on underserved markets, segments, and use cases. And what are these underserved markets? These are the forgotten market spaces and use cases not being captured by traditional banks, payment providers, and insurance companies. Think of the unbanked. There are 1.7 billion unbanked in the world, but 1 billion of which have a smartphone with data. So there are also underbanked who do not use many traditional financial services products. Another interesting stat, in the US, 40% cannot come up with $400 in an emergency. Saving as a habit is a difficult behavior to teach, and investing is typically viewed as being for the wealthy or the rich. Traditional banks and financial services firms have historically ignored these spaces and segments, considering them unprofitable. But technology enables new distribution channels and cost structures to profitably service these segments. Successful fintechs, and we expect to see more of this in 2020, tend to start with an underserved market or use case, but then either look to move up the value chain or enter another additional product or business line. We've already talked about a couple of case studies with fintechs that are laser focused on underserved markets and use cases. We had Chime focused on middle incomes and those living paycheck to paycheck. We had Lemonade for people who'd never had renters or homeowners insurance before. In addition, we also have Acorns taking on the micro-investing and saving space. The rise of robo-advisors has truly democratized investing and the wealth management space. Acorns does have a robo-advisor component to it as well. Acorns is a micro-savings and micro-investing app that works by rounding up your purchases to an even number and automatically investing the difference for you. By linking your credit card and your checking account, Acorns reads your spending habits in your credit card, rounds each transaction up to the nearest whole number. So they've really been successful by focusing on educating Americans about savings and investing, and expect more functionality to be added. Acorns has promised to be in anything that helps Americans save and invest. We also tested Acorns with consumers, and it performed really well. The no trade fees, no minimums, and a simple fee structure are what consumers like best about Acorns. And interestingly, there are also the elements that are hard to believe, suggesting that consumers, these same elements are the ones that consumers find hard to believe, indicating that consumers are potentially thinking of this as too good to be true. It's also very strong on emotional resonance. Acorns' core positioning of doing it for you with the automatic investing feature is the thing that's especially resonant. With the strong performance across metrics, we see that the archetype is what we would call a good concept, which is one of our better performing innovation archetypes. Importantly, although it's focused on underserved use cases and markets, the idea does have mass potential, and you have the potential opportunity to attract large numbers of customers. Another underserved area is payment experiences at the point of sale. Payment fintechs have been focused on enabling exceptional experiences at the point of sale in the payment process itself, with the merchant, or in the case of a firm, with the idea of credit and how you pay for what you buy. So Affirm is a fintech unicorn that has simplified and enhanced the experience of paying over time instead of using a traditional credit card. Affirm is effectively providing you a loan, so it allows users to buy products or services offered by online merchants and to pay those purchases off in fixed monthly payments. The benefit of using Affirm is they don't charge late fees, service fees, prepayment fees, or any other hidden fees. Affirm first gained traction really in the travel sector and was designed to change how people pay for flights, hotels, rental cars, enable people to take their vacations now and then pay over time and fix monthly installments. Increasingly, though, Affirm is moving beyond travel, and hundreds of non-travel brands, including Warby Parker and Peloton, featured here, have added Affirm as a payment option at checkout. Finally, Affirm also has introduced a buy now, pay later model for businesses. Most recently, we do see the small business space and translating fintech experience with consumers to small businesses as a really underserved market, and expect a lot more activity in that space in 2020 as well. So Affirm is a nice segue into the final theme we'll talk about today, which is about seeking and identifying partnerships, and especially with merchants. The world of point-of-sale financing has attracted a lot of interest lately, and it's not just fintechs like Affirm. There are other fintechs too, QuadPay, Afterpay, that are in this space. But the big payment providers are getting into POS financing with MasterCard, Visa, Amex, PayPal, all putting out POS financing offers, and Chase being the latest big player to join with the announcement of their own POS financing play. We've already talked about Affirm. Another major player in the POS financing space that's truly helping merchants deliver exceptional experiences is Klarna. Klarna is huge in Europe, of course. They recently had a $5.5 billion valuation, making it the most valuable European fintech. The way Klarna works is that they now offer 3 different buy now, pay later payment options. There's a buy now, pay in 30 days option. There's an installment option of paying in 4 installments. And finally, there's a financing option to pay over 6 to 36 months. For the consumer, this provides an easy credit alternative to buy now, pay later with no interest. For the merchant, the smooth checkout process makes for a superior experience and can even help reducing cart abandonment in studies that have shown that. Klarna has partnered with 205,000 merchants right now. It's in 17 countries, has upwards of 85 million customers. And Klarna, known mostly as a European fintech, has been making a big push in the US recently. You've probably seen some of the Snoop Dogg advertising, but you probably didn't know Klarna is now available with 3,000 merchants now in the US. They've especially made a push and a heavy push with apparel retailers. They've also started to really move the needle on consumer adoption in the US, and Klarna claims to add 6 million new American users every year. On another front, Amazon Go has created a truly frictionless experience and has completely removed payments from the entire shopping experience. If you haven't experienced an Amazon Go store, it's truly well worth the visit. You swipe in with a QR code, on your Amazon Prime app. You walk in, you pick up what you want off the shelf, you walk out. No cashier. No choosing a payment option. You just pick up what you want and walk out. And the latest news, if you've probably heard, is that Amazon is now setting up a new business where it plans to white label its Go cashierless technology and offer it to other retailers. So what does this mean for payment providers now, as well as issuing banks and payment fintechs, where payments are completely removed from the shopping experience and payment decisions are increasingly predetermined? We do expect more of that to come in 2020 and beyond, with the payment decisions being increasingly predetermined. What this means is that marketing touch points to end consumers, end users, will potentially decrease and shift further upstream. Could it mean more potential partnerships with tech companies and device manufacturers? Perhaps that is certainly a possibility, and you're already seeing that with the likes of Apple and Google. But let's not forget the role of the merchants here in the middle, and the need and the ability of the merchant to deliver exceptional consumer experiences. So potentially the most effective channel going forward may be to forge greater relationships and partnerships with merchants. And that's it that we have in terms of themes and trends today. To wrap up, let's recap briefly and talk about what we're watching for next. We've seen that to be successful in the fintech space, with a challenger or incumbent, whether it's early stage startup or late stage fintech or a bank or a financial institution, the focus is heavily on creating exceptional friction-free experiences, focusing on underserved markets and use cases, and emphasizing a strong business and revenue model. And these are critical success factors, and we expect to see more of these and more emphasis on this in 2020. But one of the questions we're asking ourselves now, and we continue to be focused on, is what makes a fintech truly resilient? Now, these elements are necessary for success, but what predicts longer-term resilience? Great experiences are necessary, but probably not enough on their own. Tech is necessary, but not enough for its own sake, as we talked about, as is a solid business model. Is it about having a forward-looking strategy, going beyond the tech and the AI, being able to go beyond the underserved markets and use cases that fintechs and digital services begin with? Is it about expecting the new competition, or about forging new partnerships to counter, as we've talked about? Or are you, truly resonating emotionally with consumers, as we've seen with some of our consumer use cases and case studies? We don't quite know what makes for true resilience yet, but we do see some of these themes taking shape in 2020, and we'll be watching closely as well. Finally, I just wanted to acknowledge that in addition to Chris and myself, Kevin also contributed heavily to the content of this webinar, although you didn't hear from him today, so thank you, Kevin. And then And that's it. So we'd now like to open it up and see if there are any questions. We do have a couple here. Let's take a look at these. Who do you think will fare better during COVID-19, challenger banks or incumbents? Chris, do you want to take that one?
Yeah, I can take that one. I think that's a very interesting question. As we talked through earlier, I think, incumbent regional or community players are they're in a tough situation. Many of them don't have a strong digital offer and rely on kind of face-to-face relationships. But when we think about fintechs, most of which will have a strong digital offer, and kind of the large incumbents, which will also have a strong digital offer, I think, neither really has an edge here, and I think it really is determined by how they act through the crisis. Is there ways that they can support their clients through this tough time, essentially? And we've seen Chime already do some movements toward this. They are the on-jersey sponsor of the Dallas Mavericks. The NBA season is delayed right now or postponed. So all those in-arena workers, most of them lower income, are kind of without their regular income. So Chime has stepped up along with the owner of the Mavericks, Mark Cuban, and said, during this hiatus, we will support you to make sure that you can pay your bills, essentially, and that perfectly aligns with their positioning. So will there be other brands that can kind of step up and regain or further their trust during this time? I think, coming out of quarantine, there'll be a lot of everyday Americans who maybe went to a bank branch to do their kind of everyday banking in the past, and they'll have to get used to doing those in a digital channel during quarantine. So they may not quickly go back to branches to go talk to a teller or things like that. So for incumbents, I think it's important to think through, does this somewhat change what a branch is for us, and are there ways that we can design branches in ways that enable deeper conversations, financial recommendations and analysis that some of these challengers can't really provide in a digital sense, and kind of repurposing branches to enable those conversations? So I think both could come out and win. It just kind of depends on their actions during the crisis, essentially.
Great. Let's take a look at one more here. Does your research suggest greater demand for insurance and protection products after quarantine? We don't necessarily have data or research on this yet, but I do think demand for insurance and various protection products will increase. As we come out of this, consumers will probably recognize sort of the greater need for insurance and protection. As we've seen we've seen this after previous crises as well. After 2009, we did see that some consumers come out after crises and are effectively, scared straight. So become more financially responsible. Think more deeply about savings or investing or insurance. And we do think that financial responsibility will likely spur demand for insurance and protection products particularly. Okay, that's it. Let's wrap up. We'll circle back directly with you if there are any other questions you might have submitted. Be on the lookout also for a recording of this webinar. And thank you all again for joining us, and have a great day.